Oh no, markets are red, tech is imploding, our pets' heads are falling off. Wait, isn't this just a reasonable pullback? Well, so far from what I can see, it's exactly that, nothing more and nothing less. So, let's keep a level head and build a game plan to tackle the remainder of this trading week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. Let's kick things off here on the SPY daily time frame chart. What do we see from a trend perspective? We're certainly still in a glaring daily uptrend with clear sets of daily higher lows as well as big time higher highs into the close of last week up here. And in this trend sequence, we know that we can search for a higher low to form anywhere above our previous breakout point here at 429.25. And thus far, the mild pullback that's unfolded here is well above that key line in the sand on the daily time frame chart. We're also technically holding on to the FOMC lows from that little blip of panic on Wednesday of last week, which coincides with the lower bound of the weekly expected move around 434.20. We also can see that on Tuesday's session, the buyers did technically print a hammer candle, and there's continued attempts for the buyers to step up around this area of support, but I will of course concede that today's daily bar close isn't the most encouraging. We did close weak down at the lows of today's session. So let's take a look at the hourly time frame chart with that information and build out a game plan with levels, right? So the first thing that everybody's going to point out, of course, is the obvious head and shoulders. Sure, it's definitely on the table, and a flush through the neckline at 340.350 would usher in lower prices to retest the breakout point from here. This is last Monday into the afternoon session. That's 431.75. Beyond that, we would achieve our daily line in the sand at 429.25. So sure, head and shoulders pans out, and yes, if we break down underneath the level, you could look for a lower high, and over time, we'll target the daily zone 429.25. Let's just keep in mind, though, that the hourly time frame chart can certainly flip into a downtrend as we're looking for a daily higher low to be found. Right? So it doesn't mean we throw everything out the window and we just flip to massively shorting this market. We can trade shorts in the downward direction because we have a clear area to get involved around. That's the neckline at 434.50. But I'm still not convinced that you want to overstay your welcome on the short side. I would be looking for any signs of potential reversal here at 431.75. You guys know the drill: hammer candles, double bottoms, inverted head and shoulders. And the same thing holds true at the daily line in the sand, 429.25. Now, if markets do continue past that, and keep in mind, we're talking about a massive extension through the lower bound of this week's expected move. We only have 2 days left in the trading week, obviously. But over time, if we get underneath 429.25, what's the famous saying here on the channel? I will certainly change my tone. We're just not there yet. A couple of takeaways on the hourly time frame chart in terms of the recent price action from today's session. Remember that we had a double distribution from Tuesday. We'll see this on the market profile in just a moment, but we've rejected the overhead distribution here in the afternoon rally attempt. Notice that, again, this lower high from here to here happens underneath the low of that zone. If I just zoom in on this, perhaps the illustration is a little bit better. This right here is what I'm talking about, right? So overall, the fact that that did happen would lead me to believe that buyers aren't quite ready to produce that daily higher low yet. But if you look at the nature of the first 2 hourly bars back here, those lower wicks certainly imply that buyers were trying to step up at a known area of support. And keep in mind, this is all happening as the Jerome Powell testimony really starts heating up and he's getting peppered with questions. So I'm not convinced that there's stronger sell side activity here, but I'm also not convinced that the buyers are ready based on this move into the afternoon. So what does that really leave us with into the end of this week? Also, a couple levels of confluence actually before we move into the game plan with levels. We already talked about the head and shoulders obviously, but if we take out the Fibonacci from here to here, we know that the 61.8 is always a key line in the sand, and once again that's going to be confluence with the neckline level we just discussed, 434.50 or 75, excuse me. If we can break down through that, we know that the odds of a 100% retracement dramatically increase. There's your daily line in the sand, 429.25. The other thing we can throw on here is the anchored view app. If we do something that looks like this, what you'll notice, it's still coming from the same anchor date. This is 2 Fridays ago when we broke out of the daily bull flag, right? That's also acting as confluence of resistance on this afternoon session. So once again, the short side is fairly straightforward. Underneath the neckline here, which is also the Fibonacci 61.8, we know we have downside outcomes. But for upside outcomes, we want to break Tuesday's high. We really want to get up and over that daily hammer candle high. And if that happens, that ushers in better long side trades to go back up to this level, 440. 440.75, and then the equal high around 444. The other thing, as we pointed out moments ago, is if we do decide to continue to break on down through the neckline, we're still looking for reversals here. We're still looking for reversals here. So it's not that it's the end of the world right now, but the hourly chart certainly would suggest, with this anchored view app now acting as resistance, with the failure to accept into Tuesday's afternoon session here, I would be all eyes on the neckline. Today's low of day at 434.50. It certainly seems as though it may want to break down, but we need to be mindful of the daily uptrend, which is still very much so intact. I would be looking for reversals here or in here. Market internals are always Exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it simple as we always do. When this pullback has unfolded here, does the dashboard look like new money selling or just mild digestion? I would have to say it looks like mild digestion thus far. The volume flows are negative on the week, so they are outflows, but they are not significant, breaching negative 500 million. We've got negative 319 million. I will give credit where credit is due. On Tuesday, there were decent outflows on the individual day, but on today's session, as we're digesting sideways, really a very, very neutral day in terms of flows. If we look at the advanced decline line, not spending any time this week in trend lower zone, and there's a big recovery effort on today's session to get up and over the zero line into the close. Don't get me wrong, it's not the most bullish indication, but it certainly isn't indicative of strong new money sellers getting active, and the cumulative tick really speaks for itself. Even as the breakdown, kind of liquidation break from the Tuesday morning session is unfolding, the cumulative build never gets aggressively negative here on the nicey side of things, and even into today's close, and slightly positive. Now, these aren't groundbreaking reads. We're not looking at a positive 4,000 read here, but the point remains, we're not really seeing aggressive selling. It looks like some mild profit taking and mild pullback as the market has moved lower. Market profile is always going to be Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. A couple of nuances to discuss here. First and foremost, where was value and point of control on today's session? Certainly lower in the profile, not towards the upper range of today's trading session, and also most noteworthy, it was breakaway to the downside in relationship to Tuesday's value. Now, it's not the end of the world for a couple of reasons here. Simply noting the lack of aggressive selling pressure from the internals, you may want to consider, okay, what if this is just accumulation towards these lows and people are building long positions at this location instead of selling things off aggressively, right? That's what the internals would at least support in conjunction with the market profile here. The most bearish takeaway from the profile is just the fact that the rally from the afternoon session once again rejected the upper distribution from the Tuesday double distribution. Now, it's not classically split as we would like to see with single prints, but you can still get the idea that there were two major zones from the Tuesday session, and that afternoon rally today rejected right at the bottom of the overhead supply, which is more of a bearish indication, right? The buyers tried to get in gear higher, simply were not able to push into that prior structure. Something I want to talk about as well is this poor low was repaired on today's session, but we've left yet again another poor low. So what could I envision into the remainder of this week if we sweep today's low and come back into today's range, and then we can get that break as we were talking about on the SPY hourly up and over Tuesday's high, that would repair the structure here, kind of confirm that this was in fact accumulation. Then we'll look for that upside rotation off of a mild pullback on the daily time frame chart. I also just want to show you, if I scrunch this chart up, we have repaired the single prints we were referring to in the weekend video from Thursday's session of last week. We've broken down, we've repaired all of that structure. So once again, fixing this poor low, sweep the lows, collect the stops, come back up into range. If we can take out those highs, kind of looks like game on for more upside to continue based on the daily trends. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLV healthcare sector is leading the pack here, up 0.87%. And as we know, it's the second heaviest weighted sector, and it's also D for defensive. So posture-wise, that would start to be a little bit more of a risk-off indication. If we pair that with the XLK at the bottom of the barrel, essentially, it's at the top of this list, but down 1.58% on the week, it's not really all that warm and fuzzy of a feeling inside, but does this make sense has to be the question that we ask, right? If you tuned into the weekend update, if we just take a quick cruise over to the XLK, we're pulling back off of an all-time high after breaking out of a daily bull flag here. So do we really want to be bearish the market if this is the situation in the XLK? Probably not. There's a strong case to be made that the XLK could try to find a higher low over the bull flag breakout level at 167.65. Something else that we discussed in the weekend update was that, hey, the XLY, it's also sitting at a known area of resistance. If it starts to cool off, what was the one culprit we needed to start playing nicely for the market rally to continue? It was the XLF for financials. And if we take a look at that chart, notice that it gapped down big time on the Tuesday session for the open and produced an inside bar on today's session. So the XLF is not picking up the slack. It's not doing the work that we wanted it to do if the market rally was going to remain healthy. So it's no surprise that the SPY itself has pulled back here. If the XLK can start to find a little bit of a footing at the top of the bull flag range, if the XLY wants to break out of its consolidation range, because it's really not pulling back aggressively, it's just going sideways via time, right? There's nothing bearish to say about this chart either. If both of those things can resolve, meaning the XLK slows down, the XLY perhaps breaks out of this flag range, or at least holds up over 163, it's still all going to boil back down to the XLF trying to recover from its gap down on the Tuesday session. The one concern I have with the XLF is very specific and nuanced, and it's the fact that we technically take out Tuesday's high in the upper wick of today's session. Let's look at this on an hourly time frame chart. So we take out Tuesday's high, and there's a big lack of follow-through in the upward direction to close the gap, right? Instead, you can see that we failed to hold on to this 33.22 support, which was coming from prior resistance back here, and we close weak back inside of the Tuesday range. So overall, not thrilled with this price activity, but at the end of the day, there's nothing overwhelmingly concerning at this point in time that is like a detriment to any of these daily trends that we've been discussing. Let's just tour through them quickly to hit all the key data points. XLV, it's really sideways in a range, even though it's outperforming on the week. XLI, holding up above the top of the breakout range here. Break, retest, looking for higher. 109 is the measured move target. We just talked about the XLK. Here's real estate doing nothing impressive. Communications, heavier weight risk on sector. I will say that this, of course, broke and closed underneath the hammer low, so perhaps some more pullback here does usher in continued pullback in the SPY. Energy, any outperformance here? Absolutely not. Still stuck sideways in this range. Consumer staples, this fell back into the bear flag consolidation range under 74, trying to test higher. But once again, any leadership issues here? Absolutely not. Not really seeing a stronger case for risk off to be made at this point in time. We just talked about the XLY flag, covered XLF utilities, not really doing anything impressive, right? We already talked about the inverted head and shoulders back here. We hit the target, which was up here at 68, and now we're just back in the midpoint of this range. No leadership issues out of the lighter weight risk off sectors. So I'm not really seeing, once again, a stronger case to be made that this is anything other than just mild and healthy pullback for our market. Even materials here holding up nicely, respecting the gap underneath us, holding the daily 50 SMA. Nothing really bearish to say about this chart at this point in time. We'll just segue right into our ratio grid here. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. But for the most part, I'm going to echo all of the same sentiments. Sure, the XLK is putting in a little bit of a double top. Is it totally reasonable that this pulls back? Absolutely. It would be ideal if we find a higher low above here, but we can still afford to pull back all the way to the upward sloping 50 SMA and not really be overly concerned. XLV, nothing impressive happening. This is not in an uptrend. It's not threatening leadership. We just saw the structural chart. XLF is trying to flatline after the banking crisis issues from back here. Really has to get in gear. This has continued to be the thorn in the side for the S&P. It's not improving as fast as we would like it to improve. XLY, we saw the consolidation. Any issues? Absolutely not. Closest tie, as we know, is the XLC, flatlining and drifting slightly lower, but looking to see if we can catch ourselves for support over an upward sloping 50 SMA. And the bottom four remain the risk off sectors. Any issues down here? No, no, and no. So just continuing to reiterate and evaluating these things closely as the pullback unfolds, is there any big shift in the sentiment of the market? And I can't see it yet based on how the sectors are performing right now. We're still in a risk-on environment, and the XLY over the XLP would confirm this. This is growth versus value, right? Clearly hanging out here at these higher highs. Any pullback that can potentially unfold that holds this prior swing high at 2.1, for example, is totally game on. So if this drifts lower, maybe the market pulls back a little bit further, and then as and if it can catch support here, rotate back higher, we will look for bullish outcomes. As a very brief comparison, right, if I do something like this and section off where the different trends are in the ratio up above, as this is trending higher aggressively, the market is trending higher. As this is drifting lower, you get pullback and tumultuous activity. As it starts to break out again, the market starts to break out again. So if this wants to pull back, we should expect that, hey, maybe the S&P cools off a little bit. Maybe we build out a long period of consolidation again. Hopefully not nearly as painful as what we experienced through April and May, but you get the gist, right? This can certainly pull back and it would not deteriorate the trends that we've seen develop thus far in the market. Over on the dollar, it looks like I spoke too soon and Thinkorswim is back to breaking some of the data, not all of it, but some of it certainly. Today's bar should be a solid red-bodied bar. If I go on down to a 15-minute time frame chart, you can see this clear as day. We basically fell off of a cliff there. And the main takeaway here is that we are technically setting up a bearish H pattern with a lower high in place in the dollar. If we can flush the equal lows, in theory, that should be upward pressure for our markets down here. So the dollar is looking good for downside. What does gold have to say about that? And is it confirming the bearish nature of that chart? Now, not all the way, because in theory, we would have wanted gold to recapture 2000 at this point in time, but there's a nuance here worth pointing out. Gold has this range that's been in play, and you'll notice on today's session, the lower wick of today's bar technically undercuts all of the lows that we had prior, and we close back inside of the range. So is this going to turn into a look below and fail? Certainly could be a situation to watch out for. A break of gold's hammer high here for the rotation back to the top of the range, aka 2000, would support the idea that the dollar can continue to break down and perhaps provide bullish pressure for equities down below. Let's take a look at the TNX and see what's going on with our interest rates here. Interest rates are stable, right? So Jerome Powell can come on and testify and talk about higher for longer all he wants, but rates have remained stable, right? And as these remain stable, that is technically what we do want to see for the XLK. Now, if they start trending again and break out of this range in the upward direction, that would be a big cause for concern, and I would certainly expect further pullback from the market. But nothing about today's daily bar, even as Jerome Powell was testifying, threatens a break of this range or up and over the top here at 38.5 roughly. So continuing to monitor this sideways, so far so good. This is certainly comfortable for the tech sector. The Fed tracker tool is pricing in higher odds of a 25 basis point rate hike for the July 26th meeting, which shouldn't really come as a surprise considering that during the FOMC announcement last week, the new SEP that was released illustrates a 5.6 terminal rate that was sort of agreed upon by the Fed board, right? So that would imply 2 rate hikes here, but if we look at the probabilities tab, we're actually only pricing in 1 more rate hike and then holding higher for longer, not getting that additional hike to achieve 5.6. So the battle right now from the fundamental narrative is really 1 versus 2 rate hikes into the end of this year. And then we can see that, yes, we do continue to price in cuts in early stages of 2024. If you were tuning into Jerome Powell's testimony today, we really didn't learn anything new or insightful for our markets other than the fact that he likes the Grateful Dead. He continued to reiterate the fact that, hey, the ultimate goal, the terminal rate, is a completely separate issue. So you have terminal rate over here, then you have the speed at which you hit the terminal rate over here. So they want to be data dependent. I will think, or I would assume rather, that the market would be slightly shocked if we do start pricing in 2 more rate hikes. We would have to adjust for that, and it probably does lead to more of a bearish stance, at least in tech in the short term. But once the rate cuts start coming in, as long as they're for the right reason and inflation has ticked lower, I do think that the soft landing narrative is still very much so alive. So once again, Jerome Powell likes the Grateful Dead. Other than that, nothing new. I wouldn't expect anything to really come out of tomorrow's testimony other than more political theater. So save yourself the time and just watch markets. Let's move along to risk appetite. So TLT relative to the S&P did tick higher on today's session and as this pullback has unfolded in here. So I've got to give credit where credit is due, but am I concerned about a big risk-off move unfolding? Not really. We're still well underneath this descending trend line here. When and if we breach that in the upward direction, maybe conditions are deteriorating in a more substantial fashion, but no flight to safety trade that I can recognize here in this ratio yet. Let's take a look at short-dated bonds versus longer-dated bonds. You can see that this is still hanging in sideways. It did not make a new swing high, and this one is trending in the downward direction, speaking to better certainty from the market in terms of what the expectations are of the Federal Reserve. Let's take a look at the HYG, and of course that stability is a good thing. That's bullish for markets, right? If we look at the HYG, this starts to become slightly concerning. A preemptive breakdown of 74.53 would be the equivalent of the neckline break out of our S&P 500, so watch this early on in tomorrow's session and possibly Friday as well. If the S&P is holding on to hope here and the HYG is broken down underneath 74.50, kind of a red flag, at least dial back the long-sided expectations, then it would be irresponsible of me to not at least bring up Bitcoin as well with the massive move that's unfolded in here. Now, there's really two things that are going on. 90% of the reasoning, I believe that the Bitcoin market is moving higher, of course, is the BlackRock supposed ETF that's basically the spot price of Bitcoin, leading to broader-based adoption of the cryptocurrency, right? Then you have another 10% perhaps coming in from the discussion today out of Jerome Powell about central bank digital currencies, right? And just the idea there would be that people will likely flock to Bitcoin as the preferred digital currency because it's not centralized versus playing nicely with what not necessarily the Fed, but the government wants to institute, where there's likely going to be some overreach and just people are not interested in that, right? So 90% BlackRock, maybe 10% from Jerome Powell and that conversation coming up today. But for the most part, once again, this does speak to a more risk-on environment down below in the financial system as a whole, not one-to-one, as I'll always say, but certainly optimistic, not pessimistic. The main takeaways from the breadth charts as the market has pulled back is just to gauge how aggressive the deterioration or lack thereof is. New highs versus lows is still well above the zero line here. It needs more work in the upward direction, but it's certainly not jeopardizing a big breakdown here. That does strike me as a bullish nuance as the pullback has unfolded. Same thing can be said here about the SPX A200R. Mild pullback, still above the 50% mark. That looks good to go. And if we check in on the SPX A50R, the most sensitive, now on a daily time frame chart, even as the market has pulled back, this, which really put in a dramatic switch here and here, has mildly pulled back and is remaining over the prior highs around this area. So it does strike me as a healthy pullback thus far in terms of market breadth. We can even look at something like the RSP equal weight S&P, and if we zoom in here, we're just getting a pretty nice break and retest of this level. Break, retest, trying to find a bottom here with the spinning top forming on today's session. As long as 145.75 holds, that does strike me as a bullish implication for the weighted equities down below in our regular S&P. Let's check in on the Dow Industrials versus Transports, unable to break in industrials over this high. So does it make sense that the market's pulling back? Absolutely. I mean, transports tried to go and industrials said, hey, not yet. So pull back, totally reasonable here. As long as we can pick up a higher low and reattempt it in short proximity of time, then we'll look for the break, and perhaps at that point, the S&P market has pulled back substantially enough and we can look for trend continuation. So everything's adding up here, not really seeing any red flags out of breath. VIX volatility, brand new lower lows. I'm not even going to bother with my spiel as we've done in prior videos over the past couple of weeks. VVIX, it is creeping slightly higher here. It's something to keep an eye on, but as VIX has pulled back, the market's also pulled back. So if you're blaming it on zero DTEs, don't worry, I've got a chart for you as well. The VIX futures, strong contango here, and even in the 9 versus 30-day VIX, look at where we're at. We're underneath the zero line, the 1-day VIX down here. So once again, if you're a zero DTE, market's broken type person, the 1-day VIX, which accounts for zero DTE, is floored at some of the lowest things that we have in the history of this instrument. So volatility continues to be a non-issue, once again supporting the idea that this is a mild pullback, not an outright panic sell. QQQ daily time frame chart is still very much so in an overall uptrend, and we're searching for the higher low. Now, I will completely admit that the daily bar, just like the S&P 500, is not all that encouraging, with a very weak close down towards the lows of today's trading range. And we're also sitting right on a very nuanced area of support that is susceptible to breaking down. So let's talk about that actually on the hourly time frame chart and build a little bit of a game plan over here. So first and foremost, just like the S&P, there's your head and shoulders. You could already make the argument that we've broken down through the neckline of this, which would have been a trend line instead of a horizontal level from the liquidation break earlier on in this morning's trading session. Now, the interesting nuance from the afternoon rejection is not that we rejected the upper distribution from Tuesday, but just the fact that we rejected Tuesday's range as a whole there is fairly concerning. So bears a little bit more of an edge here out of the QQQ, but how could I envision this really unfolding into the remainder of this week? Well, as I was just pointing out, this is a very nuanced level of support here, the lower bound of the expected move as well. Remember, originally it was a gap fill reversal from here. This is the FOMC volatility, and we ticked it right to the T on today's low, 360.75. You have to imagine that there are a number of stop losses that are placed underneath that, and if we can sweep the low and come back into range here, what is the potential outcome, right? You would look for something that perhaps does this, sweeps, comes in, and now we have a double bottom neckline in play at 364.25, right? So if we can breach that, it's game on for a daily higher low to be found, and we will look for upside outcomes into the remainder of this week. If you're not comfortable taking the break of that neckline, of course, your next phase would be to look for a higher low above the neckline. Then we can walk up our targets. Tuesday's high comes to mind, and then the Friday breakdown level at 369.65 would be the next level to look out for. Now, if this does not unfold that way, and we just get bear flag consolidation here, break the low, and get a lower high underneath, of course, we're looking for a retracement through the thin structure from here, which led to the breakout in the first place. But when and if we get to that daily level, 357.25, that's our line in the sand for the break and retest on the daily time frame chart. I would certainly put my thinking cap on and look for any signs of reversal, double bottom, inverted head and shoulders, everything that we're typically talking about. If we take out our Fibonacci's from the low of Monday, last Monday that is, to the high of the move here, we are sitting right at that 61.8, very similar to the SPY from that perspective. But once again, this low strikes me as being much more meaningful. It's not technically the 61.8 here. So 360.75. And if we take out the anchored view app, this gets interesting as well. Let's adjust this so it's anchored to the Monday breakout day, right? So up 3 days, good to go. What you'll notice here is that the anchored view app offered resistance as well. So confluence of resistance at that 364.25. So I will concede that, yeah, bears remain in control if we're underneath here. But if we can get that break and retest for a higher low above, looking much better for those bullish outcomes and the uptrend on the daily time frame chart to remain in play there. So 364.25 key level for upside, 360.75 key level for your downside. Let's take a look at the market internals for the Nasdaq side of things. No aggressive outflows on Tuesday, unlike the S&P. Just like the S&P, no aggressive outflows today as an individual day, so no net aggressive outflows on the week thus far. We're not up and above the aggressive threshold, which is negative 600 million out of the NQ side of things. The advanced decline line climbs into the close Tuesday and into today's close on Wednesday. This is the most concerning look. It's the cumulative build that is very aggressive lower on the liquidation break from the Tuesday session, but notice I would argue that price-wise, if I zoom in on this chart over here, the liquidation break this morning was far more aggressive than what we saw on Tuesday. But look at what your cumulative tick did. It really did not build and pick up in the downward direction. So exchange level wouldn't really say that the sellers were getting all that active. You can see much more of a distributed move into the close here versus all of the activity below on the Tuesday session. So once again, stronger sellers or mild pullback sort of aligns, to me at least, with the mild pullback theory thus far. Taking a look at the market profile for the NQ specifically, just like the ES, we certainly have value area lower, point of control lower. It's breakaway to the downside in comparison to the Tuesday session. We don't really have much to talk about in terms of the single prints off to the left, but what we do have to talk about is the bearish rejection of the overhead supply here out of the NQ, right? We saw, and of course, this is because of the dividend payout from the QQQ. This is going to be different, but we open here. Where is the open? The open's right here on the NQ futures. We rally first. So there was an attempt to move into the upper distribution of the NQ from Tuesday. It rejects, leads to liquidation break, and then the consolidation is lower in the range, right? So once again, if there is a big bearish takeaway from this market right now, it's just the lack of acceptance inside of Tuesday's range. But I think we can solve that with a sweep of the very precise and technical low. Let's go back to the QQQ, right? Sweep of the low, pick up all the stops, and if this takes place, I think we're game on for a break of that neckline. Doesn't mean it has to unfold that way, but I would be very open to that idea if you start to see it unfold. IWM daily time frame chart is still very much so trying to resolve this breakout range in the upward direction if you think about it from a weekly perspective, right? We are trying to build out bull flag consolidation up here outside of the break over 179, but things are getting a little bit iffy towards the bottom end of that flag consolidation range. The only clear way to really look at it is here on the hourly time frame chart. Sure, the head and shoulders is trying to pan out, right? If you think about this as your head and shoulders, we know that the neckline was here at 184.75, but you've got some really interesting nuances taking place. So if Tuesday was going to turn into a look below and fail, right, on the bottom end of the range underneath the neckline of the pattern, then as we breach Tuesday's high, which was technically a daily hammer candle, we should look for the rotation to the top of the range. Now, what you'll notice is today we open here, we test lower, no selling pressure noted by the lower wicks in the first 2 hourly bars there, and we actually do end up breaching Tuesday's high into the close, right? But where do we actually settle out? It's back down underneath. So not really convinced that the look below and fail case is being met yet. The buyers aren't stepping up aggressively, but neither are the sellers, right? Notice that the lower wick of the first hourly bar goes right to the area that defines the single prints and thin structure underneath us, and that's where the buyers aggressively step up to keep prices pinned towards that 184.75. So the outcomes here in the IWM aren't so clear, considering that the daily trend, or at least hourly trend, I should say, in this range is not well defined. It's not an up or downtrend at this point in time, perhaps bordering on a new downtrend with highs, lower highs, lower highs, lows, lower lows, lower lows, right? So maybe a very nuanced downtrend, but really more balanced than anything else. This doesn't really offer up a ton of tradable opportunities into the end of the week, right? Because for the remainder of the upside rotation to unfold, you got to clear today's high. And, you can make the argument that this risk reward is just awful, right? And I would agree with you. So upside isn't so clear. Instead, I would look at this as a gauge for market sentiment overall and risk appetite. Small caps are basically representative of that. If we remain over 184.75, it's helpful for the bull case across broad markets. If we remain underneath, then the tradable outcome is a breakdown into the singles. That's bearish for broad markets as a whole. And the level is 183.50. If we take out the anchored view app, the Fibonacci's are obviously not going to be very much help in here in just a sideways range. But if we do something like this, and we've got to retract that 3 days, there we are. So this is the breakout anchored view app, right? As people are building net long positions in here, expecting continuation out of the IWM and small caps, this is going to start to reflect the quote average position that traders are holding from. Notice it's today's high of day, right? So if we remain underneath it, yeah, maybe there's some more bearish pressure and we'll watch for the breakdown through the singles. And if we start to get above it, people will be incentivized to add to the position, but you've already seen 1 and 2 failed breakouts in the upward direction. Not overly convinced by IWM at this point in time, but I do think that today's high of day will be an inflection point. If we're below, lean on more bearish outcomes. We have the breakdown point in here, 183.50. If we get back above, it's helpful for broad markets as a whole, but the better trading opportunity on the long side for IWM is a big break and higher low over 187.50. Nothing about this daily or even hourly chart would suggest that as of right now. Apple kicks off the core list of companies, and we can certainly see a daily hammer candle that's formed here, which makes our outcomes quite straightforward. If we can take out the hammer high, we will look for trend continuation in the upward direction, and we'll think of this as a higher low. The issue really arises if we take a look at the hourly time frame chart around 184.50. Obviously, there's your high of day. If we breach it, once again, we know about the upside outcomes, but into the close, we failed to hold on to prior support, what was once coming from resistance and resistance. So 184.50 is a key inflection point early on the Thursday session. If we remain rejecting underneath it, you could look for the deeper test once again of 182. All right, so that's Apple in a nutshell. Those are your 2 key levels. Let's take a look at Netflix. This one is breaking down. It did close the gap on today's session. The hourly chart is a better depiction over here. In the pre-market live stream, we were talking about the double top neckline offering a rejection. Anything that stayed under 436.50, game on for downside. That did pan out, and now we have an hourly bear flag in play after producing an hourly downtrend, right? So highs, lower highs, lower highs, lows, lower lows, lower lows. If we're looking for this to continue, you want to see bearish consolidation here to then start targeting a gap close. 414.75 to 410.50 is the next structure to pay attention to. If this is going to turn into a double bottom, just like your QQQ, obviously you can watch your neckline at 426.75. Just understand you're fighting an established hourly downtrend at this point in time. Next up is Tesla. This is still an hourly time frame chart. Good thing in the pre-market live stream, we were not advocates for new money longs up here. The move was on Tuesday, gave it all back on today's session. So certainly an H pattern, just like everything else, the same ideas are really in play. If we flush the equal lows at 258.75, look for the lows down here, the test coming from prior resistance at 250.75. If it is going to turn into a double bottom, needs to get price acceptance back over 262.50. Because of the aggression on the downside from today, I would want to be a believer only after higher lows above that level, 262.50. Google, thank the high heavens in the market, finally breaking down underneath the 122 level we've been talking about for what feels like weeks now. So the lower high that was produced here on the Tuesday session under 123.75 cemented the failure from this gap up. The lower high here, right? There was no opportunity for a recapture, something that did this, and we flushed the key level on this morning's session. If you were watching the pre-market live stream, we talked about this in detail. So that move has unfolded, just like the Tesla move unfolded on the Tuesday session. Today was a give back, basically. The Google move has unfolded here. Would I continue to chase it in the downside direction? It's possible that you see continuation based off of a bear flag here, and also the concept of consolidation usually leads to excess. A doubling of that range brings you closer to 119. If you just extrapolate that off to the left, maybe it's this prior low. But if we go back to a daily time frame chart, you could certainly make the argument that this is a daily head and shoulders, right? We've broken the neckline on today's session. A measured move would be something that looks like this, that really gets you much closer to this breakout point at 117.50. So Google, it could see downside continuation based on the hourly bear flag paired with the daily head and shoulders that we're breaking down from. Here's Metaverse and the Fantasyland inside bar on today's session. This is a daily time frame chart. So daily inside hammer, the trade setup is very clear. If you break the 2-bar highs, you look for continuation. Equal highs on the table, 289.60. If we just consolidate, there's nothing to do here as long as we're above 275. So I would continue to maintain a bullish edge out of Meta just based on the structure. For bears to really have something going on, it's got to be a break and lower high under 275 to start to threaten the head and shoulders. We're just simply not there yet. Some decent relative strength out of Meta. Same thing could be said here about NVIDIA. Obviously not in regards to the head and shoulders unfolding, but relative strength absolutely. Testing the low of the 3-bar inside day from what would that have been last Thursday. Hammer candle forms, once again, blue sky territories, whole and half dollars over the highs of this cluster. The level that you would want to use, let's go hourly time frame chart. The level you want to use is price acceptance over 436.30. 436.30 is the number. If we can breach that in the upward direction, blue sky territories, bears, don't step in front of Superman. No sense in getting involved on the downside there. Nothing about the chart would suggest it. Here's Softy giving back some of its gains and not holding up at the key zone, right? So everything else is trying to go break, retest, and higher low. Softy already broke down underneath the prior highs in here. So the bears are building a little bit of an edge. Let's go hourly time frame chart and illustrate what we're looking for. Anything that consolidates inside of the range, not all that impressive, nothing to do. If we rally, look for rejections off of 338. If we remain underneath that, that cements more of the bearish idea, and we can rotate back down into the daily range, getting closer to this breakout point from here at, 328.65 daily. That should be inverted hammers. No, what am I looking at? Oh, it's back here. Yes, it was. Inverted hammers from right there. Let's take a look at Amazon. Last but not least, the mini beast. This is stuck sideways in a range. It's still trying to build out this as an ascending triangle. We've been going wall to wall with our 127, 125.50 range. Here's the hourly time frame chart. Notice that the morning was a rally, then we fall through it, then we rally back into it. So all over the place out of Amazon. For upside, it's a complete patience play based on the lack of decisiveness in here. It's got to be a break and higher low over 127 before I'm a believer in anything. For downside, it's almost the same. It would have been more ideal if we remained in the consolidation to offer downside trades like this into the 123.25, but now that's just the key zone, right? Start treating this as an overall balance range. If we're just in the range, we're currently closed in the midpoint. Not much going on. Not much going on. So treat this with balance. Treat it with respect. Bottom 123.25, top 127. Let's get into some trade ideas. First idea is on PayPal. It feels like this thing is trying to come back from the dead with a 100% retracement, but notice we have decent structure on the move back higher. It's a break, consolidation, break number 2, inside bar hammer on today's session, respecting the 50 SMA on the daily time frame chart. Above us is a gap from the prior earnings cycle. I'm not calling for a full gap close into the end of this week, but over 69.50 gets interesting to close the gap up towards 74.80 over time. Let's take a look at the hourly time frame just to establish where our key line in the sand should be. As long as price stays above 66.75, that would be the number I use, 66.75. Let's throw that on together. Somewhere right around in this area. As long as we're inside this 2-bar range, building out a bull flag, looking for upside outcomes. If we start to breach it in the downward direction, not so interested in PayPal anymore, considering that the overwhelming daily trend is down as noted by your daily 200 and daily 50 SMA here. Next trade idea, last but certainly not least, is DBX for Dropbox. Nice looking flag, is it? Not quite, right? Here's the takeaway with Dropbox. Technically, today's inverted hammer upper wick breaches the prior 2-bar range highs, and we completely reject those upper prices. So if this was going to turn into a stronger breakout in the upward direction, we should have closed at least above the prior 2-bar range, not at the lows of the 2-bar range. So I'm looking at this as a failed breakout from Dropbox. And if we take a look at the hourly time frame chart, we can see this clear as day, right? Multiple rejections early on in this morning session. We try to get some momentum above, right back down to the lows and consolidate out weak into the close of today's session. You could get very nuanced and say, hey, it's a head and shoulders. I would just think of it as a failed breakout, right? If we take out the lows of that flag consolidation range, 25.65, your next downside target is here at 25.07. We're not dealing with a lot of range out of Dropbox, and I'm not even entirely sure whether or not Dropbox is easy to borrow on Thinkorswim as a short setup. The options chain, I can tell you right now, is not fantastic. So with that said, treat this as a potential learning opportunity and understanding the psychology of this upper wick. Not every trade idea that you spot is going to be executable, but if you understand the concept of what happens here in Dropbox psychologically with the buyers who got suckered into a fake break, you can apply this to any other setup that you see in a similar vein. So even if Dropbox is not easy to borrow and we can't short the shares, treat this as a learning opportunity with this particular trade setup. It happens all the time out there in the market. Just so happened to find it in Dropbox for today's session. So that's going to wrap it up for the midweek market update. If you learned anything new or enjoyed the video, let me know down below in the comments section or by giving the video a simple thumbs up. I hope to see you all tomorrow morning in the pre-market live stream. 8:15 is when it kicks off. And with that said, I wish you a green trading week.